welcome to this Bell Direct monthly update. I'm Julia Lean, equity strategist with Bell Direct, and the month of May was a bit of a mixed performance. You could say it was a performance of two halves. The first was before three of the big four banks traded ex-dividend, with the market rising 2.6% up till the 14th of May. But post the 14th of May, once the banks started to go ex-dividend, we did see the benchmark ASX 200 down by 1.9%. So overall, the month of May looking pretty flat. The other weight on performance was Telstra, which was down a massive 11% for the month. But having a look at some of the best performers and worst performers on the ASX 200 index, and the best performers were driven around by turnarounds, and they were WiseTech, Seven West Media, as well as Challenger. WiseTech, of course, had a disappointing profit announcement in its half-year numbers back in February, but has rebounded back strongly on the back of some stronger commentary coming through from the company. The stock up a massive 42% for the month. Seven West Media up by 35% and Challenger up by 22%. This performance means that both Challenger as well as Seven West Media breaking into the black for the 52-week performance. The worst, though, were driven by profit downgrades, a continuation on that downgrade cycle, as well as regulatory risk emerging. In terms of profit downgrades, it was Green Cross which was impacted, the stock down by 18% for the month. Meanwhile, a continuation of that downgrade cycle that Retail Food Group has been stuck in meant that the stock fell another 16% in May. And Link we saw coming under pressure because of regulatory risk, with some of the superannuation changes flagged by the budget, and Link was down by 15%. Moving into June, it becomes all about confession season. This is where companies come out with any divergence from their expectations before the full year earnings season kicks off in August. And we have seen some early upgrades and downgrades. Early off the benches on the upside includes stocks like ARB, Aristocrat Leisure, as well as CSL and Qantas. On the downside, though, we have seen a dampening of expectations from stocks like AMP, Amcor, which has warned about rising costs, Green Cross, JB Hi-Fi, Invocare, Gateway Lifestyle, as well as Technology One. Having a look at this confession season, in particular in focus are some of the stocks with very high or low expectations, and stocks in an upgrade cycle with extremely high expectations include stocks like A2 Milk, Altium, Corporate Travel, NextDC, as well as Nine Entertainment. If there are any inklings that these stocks aren't going to continue in this upgrade cycle, then expect to see severe share price pressure, and frequently we have seen stocks falling 20 to 30% if they don't meet high expectations. Stocks in a downgrade cycle, though, meaning low expectations, include stocks like Myer, Fletcher Building, as well as Domino's. So if we see relatively good news come out, we could see a share price rebound in some of these companies. But positioning for the rest of the 2018 year and having a look at the second half of the year, once again, it will be late cycle investments which will be in focus, and traditionally energy, commodities and healthcare tends to perform well at this part of the cycle. But it could also be about reducing domestic exposure and increasing global exposure, in particular diversifying to regions which are earlier in the economic cycle rather than late cycle. And there will be an increased focus on strong balance sheets with low refinancing risks as interest rates around the globe continue on their upward trek, and rising importance on earnings quality as well as predictability. But here at home, we're expecting to hear more about slowing housing and what type of risks that presents. We have seen home prices now down 7 consecutive months, and it looks like May will also be a weak number. So it looks like risk will be skewed to the downside in terms of the housing market. Of course, the biggest area with exposure are the banks, and the big question here is whether we are going to see a full-blown loss cycle or just write-backs and recovery. The banks, though, are supported by the regulatory environment, which means that we're more likely to see write-backs and recovery rather than a full-blown loss cycle. So here we are looking at trading opportunities as well as yield support kicking in for the banks. Some other stocks that may be impacted include stocks like Stockland, which has exposure to medium density housing, although as well as weak retail, although it does have diversified earnings streams. And we're also avoiding domestically focused building material companies. But I guess looking overseas, and one of the things helping to support the market is strong US earnings. We've seen the end of first quarter earnings season, and I guess we've seen a very positive one where we have seen earnings growing by 25.6% over in the US. And although some of that is due to the Trump tax cut, that's probably more around the 7.5% mark, which still leaves underlying earnings growth of 18.1%. The key question for investors and the market is, are we seeing peak earnings growth? Stock markets do typically turn down well before an economic recession, and many tops occur even before there is trouble on the horizon. At the moment, the market is supported by that earnings momentum as well as valuation support, and there is also a healthy amount of skepticism and doubt regarding the late stage in the economic cycle. And that probably means that markets are not being optimistic enough. We are yet to see significant euphoria, which signals a top in terms of the market. But the doubts and the cases are building, and that's what the market is watching for. So watching for whether the market has seen peak earnings growth, and that's going to be a key in the second half of the year. But of course, if you are looking at globally, then where we think that emerging Asia and Europe look quite interesting. Japan remains under-owned, China looks interesting, as well as Taiwan, South Korea, India, Malaysia, and Thailand. In particular, in emerging Asia, we are seeing growing demographics, which should drive a long-term GDP growth trend, unlike a lot of the developed nations around the globe. In fact, if we have a look at expectations around for growth, we are expecting to see the global economy grow by 3.4% in 2018, but emerging markets are expected to perform much better than this with growth of 5.9%. So it does look like the second half of the year could once again be about those international markets, in particular looking at those emerging markets, especially emerging markets in Asia. I'm Julia Lee, an equity strategist at Bell Direct. Hope to see you next time.